Imagine a financial system so large it rivals traditional banking, yet operates with almost no rules. By the end of 2019, non-bank financial intermediation, what regulators call shadow banking, held about $200 trillion in assets, nearly half of all global financial assets. This network includes hedge funds, private credit, and complex derivatives. Unlike your local bank, these institutions have no deposit insurance, no lender of last resort, and little transparency. When Lehman Brothers collapsed in 2008, it was the freeze in short-term repo lending, a core shadow banking activity that triggered panic across markets and forced emergency intervention. Today, the sector is even more deeply embedded in the financial system. The question is, what protections do you actually have if this invisible system comes under stress? Most people assume their money is protected by layers of regulation and insurance, but there's a vast sector of finance that operates outside those boundaries. The world of shadow banking. This system is made up of non-bank financial intermediaries, hedge funds, private equity firms, money market funds, and a complex web of investment funds and derivatives markets. They perform many of the same functions as banks, but without being subject to the same oversight. The scale is staggering. According to the Financial Stability Board's 2023 report, non-bank financial intermediation held $217.9 trillion in assets by the end of 2022, accounting for 47.2% of global financial assets. That's nearly half the entire financial system, and it's all happening mostly out of public view. These entities range from investment funds and insurance companies to pension funds and real estate trusts. Some segments, like money market funds, have even grown during periods of banking turmoil, while others have contracted due to market losses. The diversity of participants makes this system both resilient and unpredictable. What sets shadow banking apart isn't just its scale, but its structural vulnerabilities. When you deposit money in a bank, it's insured and the bank can access central bank liquidity in a crisis. Shadow banks don't have these protections. Instead, they gather funds through investments, not deposits, and lend or trade with them without access to deposit insurance or direct central bank support. Collective investment vehicles, such as hedge funds and other investment funds, are not covered by deposit insurance, and their assets are typically ineligible as collateral for Federal Reserve liquidity, as outlined by the 2A7 rules. This leaves them exposed to sudden liquidity shocks. A clear example came in September 2019 when the overnight repo market, a critical source of short-term funding for both banks and shadow banks, saw borrowing costs spike above 10% in a single day. The Federal Reserve responded by injecting more than $75 billion per day into the system through repo operations. But the vulnerabilities didn't stop there. In March 2020, as the pandemic hit, non-government money market funds faced over $120 billion in outflows within a week, forcing the Fed to step in with emergency lending facilities to prevent a broader collapse. Private equity and hedge funds introduce further instability. They often lock up investor capital for years and make highly leveraged bets on markets ranging from corporate debt to real estate. When too many investors demand their money back at once, liquidity can disappear rapidly. This dynamic played out during the UK pension crisis in 2022, when leveraged bond strategies nearly triggered a cascade of failures in retirement funds. Traditional banks and shadow banks are now deeply interconnected. Banks rely on shadow banks for securities lending and short-term funding, while shadow banks depend on banks for access to payment systems and liquidity. When a major player falters, the disruption can spread quickly across both sectors, as seen when Archegos Capital's hidden leverage unraveled, leaving global banks with billions in losses. The influence of shadow banking now extends to pensions, mortgages, and corporate lending, growing in part because these entities operate outside the regulatory perimeter. Their ability to sidestep capital requirements and stress tests has fueled explosive growth, all while remaining largely hidden from public scrutiny. But the real question is how this system managed to expand so rapidly in the first place. The answer lies in what happened after regulators tightened the rules on traditional banks. After the financial crisis, the regulatory landscape for banks changed dramatically. Capital requirements increased, stress tests became routine, and oversight intensified. These reforms were meant to make banks safer, but they also made traditional lending less profitable and more cumbersome. As a result, many financial activities migrated to institutions that weren't subject to the same constraints. This is regulatory arbitrage in action. Financial services gravitating toward the least regulated channels. The impact is clear in the growth rates reported by the Financial Stability Board. The narrow measure of shadow banking, focused on activities that most closely mimic traditional banking and carry similar risks, grew by 11.1% in 2019, outpacing the 7.1% average annual growth seen between 2013 and 2018. By the end of 2019, this segment reached $57.1 trillion, representing 14.2% of global financial assets. This shift wasn't gradual or accidental. It was a direct response to the tighter regulatory perimeter around banks, which pushed credit creation and risk-taking into less supervised corners of the financial system. Private credit stands out as a particularly fast-growing segment. The OECD estimates the global private credit market at just over $2 trillion as of April 2024, amounting to roughly 12% of all bank loans to non-financial corporations. Non-bank lenders have increasingly stepped in to provide financing to businesses that no longer fit within banks' tighter lending standards. This trend has accelerated since the crisis, as investors searching for higher yields poured capital into private lending funds and direct lending vehicles. Official data shows that assets managed by other investment funds, many of which focus on private credit, grew at an average annual rate of 11% between 2013 and 2019. The relationship between banks and shadow banks has also evolved. While banks once dominated corporate lending, they now often act as financiers to non-bank lenders, supplying the funding that allows these firms to expand. This creates a web of interconnections where stress in one part of the system can quickly transmit elsewhere. If corporate borrowers struggle to repay, the resulting liquidity pressure can move from non-bank lenders back to the banks that fund them, amplifying systemic risk rather than diversifying it. Private equity adds another layer of complexity. These firms use leverage to acquire companies and lock up investor capital for extended periods. When market conditions shift suddenly, as seen during the UK pension crisis in 2022, the unwinding of leveraged positions can be abrupt and disorderly, with ripple effects across both shadow banks and traditional institutions. The expansion of shadow banking is rooted in the search for regulatory gaps. As rules tighten in one part of the system, activity flows to where oversight is lighter and constraints are fewer. This has made the financial system larger, more interconnected, and more opaque. But the real test comes when stress hits, because the way shadow banks are structured leaves them uniquely exposed to sudden shocks. This fragility is built into the core of shadow banking. Entities known as collective investment vehicles, like hedge funds, money market funds, and certain investment funds, hold about 73% of the riskiest segment of shadow banking, according to the Financial Stability Board's narrow measure. These institutions engage in liquidity transformation, funding assets that can't be sold quickly with money that can be withdrawn at any time. The mismatch leaves them open to sudden runs, especially when markets are volatile. A clear case unfolded in the UK pension crisis of September 2022. Many pension funds relied on liability-driven investment strategies, using significant leverage through derivatives to hedge against interest rate swings. When rates rose sharply, these funds faced urgent demands for collateral margin calls they struggled to meet. Forced to sell government bonds rapidly, they triggered a downward spiral in prices, threatening broader financial stability. The Bank of England had to step in with a £65 billion emergency bond buying program to restore order. This episode showed how quickly stress can build and spread in the absence of robust backstops. Hidden leverage is another source of instability. The collapse of Archegos Capital Management in March 2021 made this clear. Archegos, a single-family office, used total return swaps to quietly amass $10 billion in highly concentrated stock positions. When those bets turned against them, the firm couldn't meet its margin calls. Prime brokers, major global banks, were left with over $10 billion in losses, all revealed within hours. The event exposed how opaque leverage in the shadows can transmit losses across the financial system before regulators can respond. Money market funds also illustrate the sector's weaknesses. They offer investors the promise of liquidity, but often invest in assets that can't be sold as quickly as needed. During the COVID-19 market shock in March 2020, prime money market funds experienced $125 billion in outflows in just 1 week. The Federal Reserve's rapid intervention through liquidity facilities, including the reverse repo program and redemption restrictions, helped stem the run. Yet even with these tools, the underlying risk of sudden mass withdrawals remains. Reliance on short-term funding is a recurring vulnerability. Shadow banks depend heavily on repo markets, short-term loans backed by securities, to finance their positions. When confidence falters, as it did in September 2019, repo rates can spike abruptly, signaling a breakdown in trust. The Federal Reserve's emergency injections of liquidity stabilized the market, but the episode highlighted how quickly funding can evaporate for non-banks. These examples point to a broader reality. The interconnectedness between shadow banks and the traditional banking sector means that stress rarely stays contained. When a leveraged position unravels or liquidity dries up, the effects can move rapidly through funding markets, asset prices, and even the balance sheets of regulated banks. Recent events offer a preview of how vulnerabilities can emerge and accelerate within the shadow banking system. The warning signs are clear, and the next section will examine how these near misses point to risks that remain largely out of sight. Recent episodes in global finance show how quickly stress can emerge from the shadow banking sector and threaten the broader system. The European Central Bank has repeatedly warned about the risk of instability spreading from non-bank financial firms to traditional lenders, especially during market turmoil. The reason is clear. Banks now have direct exposure to shadow banks through trillions in loans and investments, making them vulnerable to shocks that originate outside the regulatory perimeter. The COVID-19 market shock in March 2020 provided a clear illustration. Money market funds saw $125 billion in outflows in just 1 week, and fixed income funds faced even larger redemptions, particularly those offering daily liquidity but holding less liquid assets. This mismatch between what investors expect and what funds can actually deliver forced central banks to intervene with emergency liquidity measures. The Financial Stability Board's chairman has since underscored the need to address these liquidity mismatches in money market and open-ended funds, as these structures remain susceptible to sudden runs. Private credit is another area where rapid growth has introduced new risks. Non-bank lenders now hold 68% of leveraged loans, according to recent OECD and PYMNTS data, with total loans rising from $15 trillion before the Great Recession to $21.9 trillion today. These loans often go to borrowers who cannot access traditional financing, and when conditions deteriorate, as seen in early 2025 when private credit default rates rose from 5% to 5.7%, the impact on non-bank lenders can be severe. The expansion of private credit has filled a gap left by banks, but it has also concentrated risk in less regulated corners of the market. The shadow banking system's contribution to systemic risk is not new. In 2007, it accounted for 30% of systemic risk in the US, on par with the banking sector. The web of interconnections has only grown since then. Hedge funds now intermediate a significant share of treasury trades, and private equity firms control thousands of highly leveraged companies. When stress emerges in one segment, it can ripple through these connections before regulators even realize the extent of the problem. The repo market offers another example of the system's fragility. In September 2019, short-term lending rates spiked to 10%, revealing a dangerous dependence on shadow banking for overnight funding. The Federal Reserve responded with daily injections of $75 billion to stabilize the market. These episodes are not isolated. They are signals of how quickly liquidity can evaporate and how reliant both banks and non-banks have become on one another. Each of these near misses highlights the same underlying vulnerability. Opaque, leveraged positions in the shadow banking sector can unravel far faster than anyone expects. The system's size and complexity makes it difficult to track risk in real time, and the lack of direct regulatory oversight means that problems often become visible only after they've already spread. Understanding these warning signs is essential because the mechanics of a shadow banking collapse differ fundamentally from the last crisis. What happens next is shaped by the speed and opacity of this system, and why a future crisis could unfold much faster than before. Shadow banking collapses do not follow the same script as traditional bank failures. The core vulnerability lies in how these institutions finance themselves. They use short-term borrowing to fund long-term or illiquid assets. This maturity mismatch means that when confidence erodes, Investors and counterparties can demand their money back on short notice. Without access to deposit insurance or central bank emergency lending, shadow banks are forced to sell assets quickly, often in defaulting markets. The result is a fire sale dynamic, where selling begets more selling, driving asset prices down and triggering further margin calls across the system. Private repos and prime money market funds are especially exposed. They lack direct access to public liquidity backstops, which increases the risk of sudden runs. The Financial Stability Board's narrow measure of shadow banking, covering collective investment vehicles and finance companies, made up nearly 29% of non-bank financial intermediation assets in 2022. Large-scale redemptions or funding withdrawals in these segments can create systemic risk, as these entities are deeply intertwined with both financial markets and the broader economy. The 2008 crisis remained the closest example of how a shadow banking collapse unfolds. When Lehman Brothers failed, the repo collateral chains froze overnight. This paralyzed short-term funding markets and forced the Federal Reserve to introduce the Primary Dealer Credit Facility to provide emergency liquidity to primary dealers, an extraordinary step aimed at preventing a wider market breakdown. The freeze in repo markets and the resulting fire sales of assets quickly spread stress from shadow banks to traditional banks, demonstrating how tightly linked these sectors have become. Recent years have produced smaller but telling examples. In 2019, a sudden spike of overnight repo rates exposed the fragility of the system's short-term funding structure. Lines of credit were withdrawn and liquidity vanished, leading to significant losses in overnight government securities financing repos. In 2022, the UK pension episode showed how leveraged strategies in non-bank institutions can trigger cascading margin calls and forced sales, forcing central banks to intervene to stabilize markets. Central banks face real limitations in these scenarios. Their traditional crisis tools are designed for regulated banks, not for the diverse and opaque world of shadow banking. When stress erupts in non-bank financial firms, authorities often have to improvise new programs on the fly, as seen during the COVID-19 panic. The lack of direct oversight and formal support mechanisms means that a shadow banking collapse can move rapidly and unpredictably through the financial system. These structural vulnerabilities leave regulators with a dilemma. The risks are well known, but the solutions are complex and politically fraught. The next section examines whether the system can be made safer, or if the fundamental design of shadow banking leaves it as a permanent source of instability. Efforts to contain the risk from shadow banking are ongoing, but every solution comes with trade-offs and unintended consequences. The Financial Stability Board tracks $63.1 trillion in high-risk shadow banking activities across 29 major jurisdictions, representing 13.9% of global financial assets in 2022. The FSB monitors trends, issues policy frameworks, and highlights vulnerabilities, but its recommendations rely on national authorities for enforcement. This decentralized approach means gaps and inconsistencies remain, especially as financial activities shift across borders and regulatory regimes. Regulatory intervention is a delicate balancing act. Heavy restrictions aimed at curbing shadow banking could set off the very crisis they're meant to prevent, as institutions might rush to sell assets or withdraw funding to comply with new rules. Yet inaction allows risks to accumulate. The investment fund sector illustrates this volatility. While assets in other investment funds declined in 2022, money market funds saw inflows. This divergence shows how quickly capital can move within the system, making it difficult to predict where the next pressure point will emerge. Money market funds remain a focal point for reform. After 2008, the SEC introduced new regulations, but avoided sweeping changes that could disrupt short-term funding markets. Now, proposals like floating net asset values and redemption gates are under review, acknowledging that earlier reforms didn't eliminate the risk of investor runs. The 2020 market shock highlighted the limits of these measures, as even regulated funds face severe outflows and required emergency support. These case studies illustrate how incremental adjustments can reduce some risks, but often leave structural vulnerabilities in place. The Dodd-Frank Act, spanning 549 pages, primarily targeted banks and over-the-counter derivatives, leaving most collective investment vehicles outside formal resolution regimes. This regulatory gap has allowed shadow banking to evolve largely unchecked, especially in areas like private credit. Non-bank lenders now handle riskier loans that traditional banks avoid, but they do so without deposit insurance or direct oversight. When defaults occur, the consequences extend beyond national borders, overwhelming the fragmented patchwork of existing regulations. Some experts recommend targeted liquidity backstops for shadow banks, such as a dedicated reverse repo facility, a measure designed to provide emergency funding without extending blanket guarantees. This approach aims to limit contagion while avoiding moral hazard, but implementing it across diverse global markets remains a challenge. The FSB's activity-based approach focuses on the most dangerous areas: maturity transformation, excessive leverage, and liquidity mismatches. Yet enforcement is complicated by jurisdictional boundaries and the pace of financial innovation. Defining which entities are systematically important is contentious, and increased transparency can sometimes reduce market liquidity by making risks more visible to investors. The reality is that modern finance demands flexibility, and institutions will always look for ways around new rules. The system's complexity and global reach make it difficult to anticipate how shocks will propagate. This uncertainty doesn't just concern policymakers or regulators. It affects anyone whose savings or investments are exposed to these markets. Shadow banking now accounts for nearly half of global financial assets, with non-bank financial intermediaries holding 49.2% as of end 2021, according to the Financial Stability Board. The ECB has warned that liquidity mismatches in non-banks can quickly spill over to the traditional banking sector, highlighting the risks that come with this growing interconnectedness. If you want to protect your savings or pension, pay attention to how your funds or banks interact with non-bank channels. Monitor for warning signs in your own portfolio, such as sudden fund outflows or unusual widening of credit spreads. Shadow banking expands when bank regulations tighten, so understanding these links is essential for safeguarding your financial future.